Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Hello, listeners, and welcome to our 5-year anniversary podcast. It's hard to believe this much time has passed since the launch of the Alpha Exchange. I can still remember the summer of 2018, fresh off the meltdown of the XIV product, the launch of the China trade war, and the Golden State Warriors sweep of the LeBron James-led Cavs. In the car with my son Aiden, 14 at the time, I told him that I wanted to start a podcast. "Aiden," I said, "I'm launching a podcast." Nonplussed, he stared at me. "I'm calling it the Alpha Exchange," I followed up enthusiastically. "What's alpha?" he asked. After a few tortured attempts to define the word, bringing in concepts like risk-adjusted outperformance, passive investing, and manager skill, I'd gotten nowhere. I realized that a broader description was in order. Alpha is about adding value. More generally, it's about engagement, I told him. Now, of course, the Alpha Exchange is not a medium for transactions in the same way that the New York Stock Exchange is. Prices aren't whizzing by, updating in nearly instantaneous fashion. There's no buying and selling, no limit orders, no short sales. There are no tape bombs causing prices to suddenly surge or fall. There are no option expirations of the weekly, monthly, or daily kind. There's no P&L resulting from the execution of different strategies. Instead, the Alpha Exchange facilitates trade in ideas. The exchange, in the podcast context, is an exercise in sharing knowledge, perspective, and expertise in this most humbling sport called financial markets. What I've sought to do is to host these conversations to contribute to our collective understanding of risk. There's a fundamental question underpinning discussions with Alpha Exchange guests. What exposures across asset classes, geographies, trade structures offer attractive compensation for bearing risk? What relationships are incongruous? And if markets are highly efficient, a pretty defensible starting point, how might the search for alpha turn up investable opportunities? Put differently, where is money being left on the table and why? If investing is about playing offense, what does the optimal playbook look like? The flip side of this question is around playing defense. There are two components to this exercise. First, portfolio construction. We know that the Sharpe ratio of a portfolio is driven not just by the return and volatility of the individual securities within it. The correlation of the assets that comprise the portfolio has a meaningful impact as well. All else equal, of course, we want securities that produce positive returns but tend to zig and zag in different directions, dampening volatility in the process. The study of this co-movement is critically important and a frequent topic of conversation on the podcast. Next, in terms of defense, we frequently talk about explicit hedging strategies that utilize options. Where is there value in optionality? Said another way, are there opportunities to neutralize the risk in my portfolio or the risk of the securities within it at an attractive price? I can always simply reduce risk by selling securities. I can also hedge. Hedging costs money. Options cost money. Do they cost enough? If they don't, I may be in a position to reduce risk at a favorable premium outlay. As the VIX celebrates its 30th birthday, I'm noting that I've spent more than 3 decades in the financial markets, with most all of them focused on derivatives. Everyone's obsessed with something in life. History, cars, art, sports. Heck, some are obsessed with the weather. For me, at least professionally, I've mostly wrestled with the following question. Through careful study, can we identify periods where the price of market insurance is either too high or too low? The answer to this plainly rhetorical question is a resounding sometimes. In hindsight, it becomes clear as day that the period preceding the financial crisis was a cheap option bonanza. Anywhere you looked, in equities, rates, currencies, and of course in credit and mortgages, convexity could be had for a song. Yes, the VIX went from 10 in early 2007 to reach an all-time high of 81 on November 20th of 2008. That's quite a surge. But the explosion of risk from all-time low to all-time high levels in U.S. financials left the VIX ramp modest by comparison. In general, matters are considerably clearer in hindsight. According to Google, hindsight bias is a psychological phenomenon that allows people to convince themselves after an event that they accurately predicted it before it happened. This can lead people to conclude that they can accurately predict other events. In markets, this bias is especially powerful. With the passage of time, it becomes easier to stitch together the warning signs hiding in plain sight relevant to a risk episode. Now, sometimes it isn't hindsight bias, but our industry's capacity to attract individuals who specialize in BS. We all know about the grifters on X, that medium formerly known as Twitter, who have called every financial crisis in the modern era. If you call for one every few months, you will wind up having called 15 of the last 3 episodes with a 100% hit rate. But seriously, just a moment of reflection on the GFC and the outrageous disruption it wrought must lead us to conclude that everyone has a risk management plan until getting punched in the face. Thank you, Mike Tyson. Before we get started with this review, I wanted to share the results of a little word count exercise I did on podcast transcripts. Of the 140 odd podcasts, I found 1,981 mentions of the word inflation. VIX appeared 932 times, correlation 528, the Fed 1,630, crisis 1,399, hedge 1,007, volatility 2,085, but the winner by a mile was the word risk at 4,227 mentions. So that's broadly what the Alpha Exchange is about: the exploration of the many dimensions of risk that confront the market and how investors need to incorporate said risks into their decision-making process. What might the market, by way of prices, be missing? What risks are overemphasized and should be faded? What's the proper balance between defense and offense? And by injecting a consistent dose of financial history into the conversations, the podcast aims to expand the listener's appreciation for how risk events materialize. By reviewing events of market consequence, we get to learn more about how the expert guest's framework came to be. It was the author B.J. Neblett that told us that we are, quote, the sum total of our experiences. While I don't think he had market crisis events in mind, there's a ready translation to the money business. I often say that we learn the most about markets when things go horribly wrong. Just ask John Merriweather and Myron Scholes. For many, the precursor to the demise of long-term capital was the Asian currency crisis of 1997. With respect to this vol event, few had as front row a risk-taking seat as did Mike Novogratz, global macro hedge fund manager and founder of Galaxy Digital. On an Alpha Exchange podcast in July of 2020, I had the chance to solicit Mike's broad views on crisis events. He shared this.
The thing about the Asian crisis that we learned was that when leverage gets built up in a giant way and it unwinds, if it gets beyond the first fire break, it unwinds at a pace that it wants to. And so you have this fantastic deleveraging, ugly, brutal deleveraging that destroys value and way overdoes things.
At a pace it wants to. There's a definitive ceding of control implied in his words here, suggesting that market prices can become so disorderly as to resist policymaker attempts to put the fire out. In addition to being the head of the New York Fed during the global financial crisis, Tim Geithner was in a senior role at the U.S. Treasury during the Asian FX crisis in 1997. In 2007, a decade removed from the implosion of the Thai baht, Indonesian rupiah, and Malaysian ringgit, and amidst a VIX that had began the year below 10, Geithner reflected on the lessons from that experience. He said, quote, "When there was success, the common feature was what Larry Summers called the Powell Doctrine applied to international finance, the overwhelming use of force with a clear strategy for resolution. The force, in this sense, applied both to the scale of financing made available relative to the need and to the quality of the policy measures." Here you see commonality in the experience of Mike Novogratz as an investor and Tim Geithner as a policymaker, namely recognition that the financial system can fall into a dangerous feedback loop with unpredictable, undesirable knock-on effects. It is those turbulent periods of wayward asset prices, LTCM in 98, the 2011 Eurozone sovereign crisis, the 2015 flare-up sparked by China's quasi-renminbi repeg. These are among the events that brought the VIX to 40 and beyond. It's these turbulent periods of wayward asset prices that are among the periods worthy of review. We are a decade removed from the original taper tantrum. A year later, in October 2014, the Treasury upcrash occurred, a violent mid-month intraday price spike that was at least some precursor to the conversation actively had today, which is the Treasury market deep enough? Let's not forget the oil crash that occurred a month later as OPEC shocked the market on what was supposed to be a sleepy post-Thanksgiving holiday Friday in 2014. As we do a 360 around the asset classes, we can highlight many more conflagrations. Currency flare-ups, even in developed markets like the UK, have occurred. In 2016, it was the geopolitical uncertainty emanating from Brexit. In 2022, it was a short-lived but spectacular blow-up in hedging trades that sought to immunize pensions from asset liability mismatches. In newer asset classes like crypto, the pile in and then run for the hills cycle of boom and bust has at least so far been a feature, not a bug. When we think about risk events, our minds rightly are drawn to asset price collapses. That's merely the result of history. There's no equivalent 20% one-day up move in the S&P 500 as was experienced on October 19, 1987. Financial collapses are about wealth destruction. But, as alluded to via the October 2014 UST event, there is a subset of up crashes as well. The spiral higher of nickel prices in March of 2022 comes to mind. To put this one into proper context, I can tell you that the realized vol of the front-month nickel contract on up days in March of 2022 was more than 400. It was just 116 on down days during the same month. And speaking of the up crash, let's give a shout out here to Roaring Kitty and the meme stock episode that reached its most dangerous point on January 27, 2021. On that day, GME was up 235%. The S&P fell 2.5%, and the VIX surged by 14 to 37. Sheesh. I'm reminded of the Cars song from 1978, Let the Good Times Roll, which after that most optimistic opening continues, let them knock you around. Rico Kosek, please meet Gabe Plotkin. Okay, that's my setup for the podcast. What I'd like to do while I have you here is bring to life some of the themes that we've covered over these last 5 years and 140 podcasts. The theme, uncertainty. As the old proverb says, there is nothing certain but the uncertain. Or, channeling the ancient Greek philosopher Heraclitus, as podcast hosts often do, quote, change is the only constant in life. In markets, the full embrace of change feels like a must. As uncertainty is our guiding theme, I'll start by proposing a framework for categorizing it. I'm a simple fellow, and keeping track of things doesn't come all that naturally to me. So, putting items in different buckets is helpful. When it comes to matters of risk and uncertainty, I generally view them in 4 categories: economic, financial, monetary, and political. Economic is your basic stuff: growth, profits, and valuation. The stuff economists and portfolio strategists spend much of their time on. Financial is meant to contemplate the trades, systematic exposures, concentration of positions, and correlations that live and breathe within the market. At this point, we should be all too familiar with financial products that have run amok. They all seem to have acronyms: CPDO, SIV, XIV. Let's add the iron condor product that blew up in 2018. The yield enhancement strategy was called YES. No. Back to our 4 categories of uncertainty. Monetary is the Fed and its central bank brethren around the world. These unelected officials are big risk takers to be sure, and their words and actions certainly matter. And lastly, political. This bucket is meant to capture non-market market risk. Elections, referendums, cyber interference, wars, and tweets in which one country's leader emphatically asserts that his button is bigger and it works. As we got the podcast underway in 2018, there were two risks that jumped off the page. First, 5 years on, who can forget the VIX ETP crackup that occurred in Feb 18? There are just 3 instances in the history of the VIX that the 2-day increase was more than 20. The pandemic should surprise no one. Add the China FX event of August 2015. And from its close of 13.5 on Thursday, February 1st, 2018, to its north of 37 close on Monday, Feb 5th, the XIV is third. I've often said that risk on and risk off are curious cousins. The conditions that make carry trades successful almost demand their overconsumption. Here's what Dave Rogers, founder of RPO Investments, had to say about the precursor.
When people think about volatility and volatility markets and events, what comes to mind typically is the big crashes like 87 and 08 and 2015-16 more in Asia. They don't think about 2017, but in many ways, 2017 was a more anomalous, more strange event in volatility markets than any of those crashes that you could have, 14, 16 months with the low volatility that we had from the very end of 16 into 17 and January of 18 was pretty extraordinary.
John Hayvice, founder and CIO of DGV Investments, added this.
If the VIX is 10, you usually realize 8 historically over the subsequent 30 days. And if you start at 20, you usually realize 16. And if you start at 30, you'll realize 24. So it's about 20% less than that on average. The odd thing in 2017 was VIX averages 11.5 and realizes 6.5. So that volatility risk premium was extraordinarily high.
Market risk events are ultimately about the unraveling of exposures in rapid fashion. What's more rapid than a product that is mandated to rebalance in an extremely short window of time, like the XIV and its cousins in convexity? One of the themes underlying many alpha exchange discussions is the role that market participants, including and perhaps especially central banks, play in pricing outcomes. Products and risk exposures exist within markets. They peel off carry. For mark-to-market sensitive investors, they impose reaction functions. When the setup is especially one way, the hazards of crowding emerge. Gordon Lawrence, director of derivatives at Wellington, said this.
I think that was one of the real lessons learned through that period is you really have to watch how crowded the positioning is getting in a variety of spaces. Within that short vol space in particular, and what was ultimately the undoing of short vol during that period was the crowding that played out within some of the exchange-traded products like XIV and SVXY, and you could see it. You can see the shares outstanding, and you can see how much short vol exposure was building.
The wreckage from the XIV unwind was real. Sadly, many retail investors were carried out. I took a phone call from a friend of a friend who'd lost hundreds of thousands, hoping I would tell him that there was a chance that the strategy would be able to recoup the losses. It's just not how a levered vol trade works. The surviving product post the debacle, the SVXY, which started 2018 at a split adjusted price of more than 500, is now at just 97. The implosion had meaningful, if short-lived, impact on the SPX options market as well. Bid offers exploded on the deepest derivatives index in the world. The VIX shot to a premium to sister products like the V2X. As I like to say, move fast and things break. The VIX unwind is the classic keyhole effect, in which too many are trying to do the same thing in a limited window of time. Put the crash of 87, the negative print on front-month crude futures in April of 2020, and the Jan 21 meme stock episode in the same category. Large imbalances of supply and demand can result in shocking moves that leave prices vastly disconnected from fundamentals. There's a quick aside that I'd like to add, and that is what I call the, quote, paradox of risk. This describes the challenges of capturing market dislocations. At the very time when asset prices have become absurdly cheap, the opportunity to capitalize on them is compromised by the inability to deploy capital into these cheapened assets. It's circular. The largest risk-offs, definitionally, result when capital becomes scarce as large mark-to-market losses have materialized and crystallized. In the fall of '98, John Merriweather's letter to investors, a Hail Mary to raise desperately needed capital, suggested that LTCM saw a compelling set of opportunities in their favorite trades, the very trades that their giant wrong-way exposures had already suffered huge losses in. The main point is that prices become dislocated as a result of capital destruction. The dislocations are only actionable with capital, something that experiences a supply shortage. Stanley Druckenmiller once said that, quote, "The stock market is the only market where things go on sale and customers run out of the store." And with this in mind, I wanted to turn the conversation to a brief review of some of the podcast discussion that surveyed the setup into the pandemic, specifically focusing on the proliferation of short equity vol exposure that was unwound in forceful fashion during those terrifying days in March of 2020. I've been around markets for a bit now, and like other professionals, have derived many lessons from the global financial crisis. It was 15 years ago, but we should not forget just how dangerous a time it was. The volatility, especially in U.S. financials, was nearly unimaginable. To wit, from September '08 until the end of the year, the XLF experienced 38 daily moves in excess of 5%, nearly half of the trading days. And as jaw-dropping as those moves were, the SPX moves in mid-March of 2020 were scarier. A 9.5% decline on March 12th, a 9.3% surge the following day, and after having the weekend to mull things over, the S&P fell by 13% on Monday, March 16th. In keeping with the financial component of risk, I took the time to explore the setup going into COVID. A question I would pose consistently to Alpha Exchange guests around this time was the following. Appreciating that substantial price reaction in risk assets is sure to result when the U.S. embarks on a never-tried-it-before experiment of shutting the economy down, what's your assessment of the impact of the ecosystem of short equity vol products that were very much a part of the risk exposures in the market? To what extent did losses here throw gasoline on the fire? In asking the question, I'm certainly channeling some of the thought process of the convexity maven and Alpha Exchange guest Harley Bassman, who has said that in assessing big risk-off events, quote, convexity can often be found lurking at the scene of the crime. To set the stage, I asked Ben Eifert, founder and CIO of QVR Advisors, to provide an overview of this universe of alternative risk transfer products. This is hardly the kind of stuff Scott Wapner from CNBC might comment on during a session of Power Lunch. You won't find these products in the striking price column in Barron's either. In the far corners of Wall Street, a community of financial engineers is busily designing exposures in which hedge funds and other sophisticated counterparties take the other side of complex risks that banks seek to cover, for a fee, of course. The, quote, edge, as it's referred to, is the excess return due the counterparty whose capital helps to cover these tail outcomes. The backtests are beautiful, no doubt. And, as did Neil Kashkari's ill-fated cash for trash plan to save the financial system in 2008, these trades do look good on paper. Here's how Ben describes it.
You just saw every manner of toxic tail risk, flavors of different short variance types of trades, both really short-term, a lot of effectively caps on variance or call options on variance that banks were buying from hedge funds. Lots of long-term S&P variance, either outright or as spreads against other products, skew locks, hedge funds selling banks, variance conditional on a large down move in the equity market versus buying variance conditional on an up move on the equity market.
As with most outcomes, both good and bad, compounding over time matters. If I'm a vol seller with an initial stack of chips, a successful program delivers more chips my way, increasing my stack. My bets get bigger along the way. My experience of success impacts how I think as well, perhaps impinging on my ability to sense danger. Minsky brilliantly told us that, quote, success breeds the disregard for the potential for failure. In Thinking Fast and Slow, Daniel Kahneman suggests that, quote, the illusion that we understand the past fosters overconfidence in our ability to predict the future. Selling vol became a prominent source of income in the long period of low rates and low vol post the GFC. Dealers increasingly made it straightforward to flip the switch and enable end users to get paid the vol risk premium and many other common source of market-based carry. Don't have the systems to sell straddles and delta hedge? No problem. Our QIS group has a custom index you can access to earn the VRP directly. Don't want to roll futures as part of a commodity carry program? Fret not. We've got a total return index and a swap contract ready to go. The growth of structural flows that essentially earn carry left investors especially exposed to a market shock in the period directly preceding the crisis wrought by COVID. Eric Peters, founder and CIO of One River Asset Management, said this.
I've been through my share of crises, given that I've been at it since 1989, and this is a unique one. They all have their own flavors and unique characteristics, but I think this one was amplified by a whole range of things, but one of them was, big flows into vol selling programs, particularly in equity markets. And so I think it's unsurprising that with such a market shock, and I think for a variety of reasons, this is probably the worst kind of shock that could have hit this market. But it's unsurprising that if we did get a shock of this magnitude, that equities would be the first to move and would have, at least initially, the most violent move. Some of it we've seen in structured product flow, where we get structured products that provide enhanced yields inevitably through selling vol. And some of it has just been through these really large players getting themselves short vol as either a portfolio overlay or some type of risk premia. And the impact of their collective action has been to reduce vol. If everyone's doing the same thing and everyone's selling vol, they're pushing vol levels down holistically. And that has the effect of making it appear that the vol that they're already short is less risky than it probably is. And it also has the effect of lifting asset price, because as vol goes down, people can own more assets, and their risk models suggest that their portfolio isn't as risky.
To round out this segment of our review, I think the evidence is there that the setup going into the COVID market shock most likely added a layer of fragility. The same folks who would normally be chomping at the bit to sell vol in the 30s, 40s, and 50s were instead forced to buy it back in the 60s, 70s, and yes, even 80s. I'm recalling an S&P 500 variance swap unwind trade I did with a counterparty in August 2002. I quoted the level at something like 35 at 36. Nearly always a vol seller, and a quite successful one at that, the counterparty took the price in and said, "Damn, that's high." He paused and then exclaimed, "Buy it." Such is the unfortunate need to unwind prices at levels you do not want to. When the dust settled from the most violent portion of the COVID market crash, there was plenty of capital vaporized in the equity derivatives community. We know of many of the headlines. Malachite, Allianz, CPP, Aimco were among the investors that suffered deep losses. If you were long risk assets, it was a frightening period. But if you were able to hold on, the cavalry did ultimately ride to the rescue. With an expanded alphabet soup of rescue facilities, this time adding programs like the MSLP, PMCCF, SMCCF, and of course, the PPPLF. The Fed, often in combination with the Treasury, threw more than a dollop of capital at the system. By the end of July 2020, an HYG holder was even versus March 1st. But in equity vol, the losses were crystallized, with positions forcibly closed out when liquidity was awful and option prices sky high. I want to take a brief detour here and talk about famed activist investor, and accidental lord of convexity, Bill Ackman. In reading the recently released book, Chaos Kings by Scott Patterson, one is reminded of the Pershing Square CIO's appearance on CNBC on March 18th of 2020, and his assertion that, quote, hell is coming as a result of the spread of the virus. After an apocalyptic monologue, Ackman goes on to tell us that he turned aggressive buyer of stocks firmly in the crosshairs of COVID, like Hilton Hotels. To be sure, it was difficult to square the view with the decision to buy. We learn, however, that Ackman had spent $25 million in premium on a series of credit option trades, which he just about perfectly unwound for $2.5 billion. If John Paulson's subprime CDS short is the greatest trade ever, Ackman's has got to be a close second. Bill Ackman's 100 bagger speaks to the why of hedging, which I have always thought of as providing the cushion, the capital offset to become an empowered buyer during stressed markets. If you can get the timing and price right on the hedge, you essentially undo the previously discussed paradox of risk. It puts you in a position to buy when everyone else must sell. Devin Anderson, co-founder of Convexitas, said this.
If a manager gives you a strategy and it produces value in a drawdown, you need to be able to take that value and go buy stuff with it. The compounding effect of good reinvestment from one of these strategies is actually where, I think as much as 75% of the value long-term really comes from.
As the dust settled and the VIX retreated from a new all-time high of 83 to just the low 30s by May of 2020, I had the opportunity to host an Alpha Exchange discussion with legendary investor Howard Marks. Co-founder of Oaktree Capital, Howard has seen many prominent market cycles, each of which has provided valuable lessons and instilled in him a great sense of humility. In contemplating what was in store for markets and the economy with respect to the COVID crisis, Howard said this.
I think it's extremely important for people to realize how little we know about the future. If you think about it, there are four things going on today: the disease, the economic response, the oil crash, and the Fed/government response. Each of those things is complicated, unprecedented, and unpredictable. So you have four unpredictable, massive influences at the same time. And certainly their interactions are unpredictable. So my basic point is that we have no idea what the future holds. We only know anything about the future by extrapolating from the past. But when we have no history, which is relevant or comparable, we have no ability to extrapolate. So I put it simply, if you have never experienced something before, you can't say you know how it's going to end. And I think that's very important.
One aspect of the most successful investors is a deep respect for uncertainty. Soros once said, quote, I learned the hard way that the range of uncertainty is also uncertain, and at times it can become practically infinite. His protege, Stanley Druckenmiller, once told us, quote, being too confident about the market is a formula for disaster. In her book, Thinking in Bets, famous poker player Andy Duke wrote, quote, what makes a decision great is not that it has a great outcome. A great decision is the result of a good process, and that process must include an attempt to accurately represent our own state of knowledge. That state of knowledge, in turn, is some variation of, I'm not sure. I've used the quote from Voltaire recently, uncertainty is uncomfortable, but certainty is absurd. As we got through the most violent period of the market crisis spawned by COVID, it was time to survey where we landed. I had a chance to catch up with former FOMC Governor Kevin Warsh in September of 2020. Having been a member of the Bernanke Fed that engaged in the financial firefight that was 2008 and 2009, Kevin has an appreciation for market vol. He told me, quote, if you've seen one financial crisis, you've seen one financial crisis. While I tend to see commonalities across episodes of turbulence, I think there's a lot of insight to be had in thinking about what Kevin says. The VIX may have wound up peaking at the same extraordinarily high level in both 2008 and 2020, but the causes and solutions to each of these outbursts were very different. Thus, there was some overlap in the aforementioned rescue facilities during the GFC and COVID. The primary dealer credit facility and term asset-backed lending facility were initiated in both, but the Main Street-oriented facilities were a COVID focus. Kevin said this.
And so when you design QE1, as we did in the dark days of that crisis, it was to try to help the financial market functioning come back and make sure it didn't affect Main Street. When you fast forward to the 2020 shock, it hit the real economy first, and financial markets were reacting in some sense to that. To the extent there was a financial market overreaction, I think we've covered it.
I came across a recent quote from historian Niall Ferguson, who said that there is only one universal law, and that is the law of unintended consequences. We'll take this up later, but in markets, the post-GFC regulatory response aimed at neutering the degree of risk taken by dealers may have created instability in the Treasury market in March of 2020. It may, in turn, have played a role in the increasing reliance on the basis trade, popular among hedge funds in helping the U.S. government complete its auctions. For Kevin, this law of unintended consequences applies as well to the Fed's prominent role of markets during the nearly entire period between the GFC and COVID crisis. About that period, Kevin says this.
I ask questions, however, of policymakers who devise a system where central bankers end up being large purchasers in benign times and then have to be still larger purchasers when times get tough.
Let's spend just a little time on geopolitical risk. These are market risks of non-market origin. The actors that comprise the geopolitical stage are often driven by non-economic goals, and these risks do not typically fit neatly into an Excel spreadsheet. And because that's the case, geopolitical uncertainties can have profound impact on the price of risk in the market. I can certainly recall the outrageously high level of British pound implied volatility in the weeks before the June 24th Brexit vote in 2016. Later that year, the fleeting but real Trump uncertainty was evident in the VIX in early November 2016. The emergence of far-right candidate Marine Le Pen the following year in the French election also made its way into vol and especially skew. Later in 2017, the lowest equity vol year in more than 50, an angry, likely all-caps Trump tweet aimed at North Korean leader Kim Jong-un would send the VIX soaring by 44% in one day. Mind you, it was from 11 to 16, but a large jump on a percentage basis. I've been excited to host conversations with geopolitical experts on the Alpha Exchange, including Alex Kazan, the Chief Strategy Officer at Eurasia Group, Libby Cantrill, the Head of Public Policy at PIMCO, Robert Dannenberg, the former Head of Counterterrorism Center of the CIA, and Maziar Minovi, President of Eurasia Group. I had the chance to catch up with Rob Dannenberg in November of 2022 as the Russia-Ukraine conflict was deepening. In listening to someone with Rob's perspective, gathered over 3 tours of duty in Russia as a spy, you get the sense of just how important and complicated the backstory is in how these relationships got to where they are. Shakespeare told us that, quote, past is prologue. Rob says,
for me, the secret sauce to being an advisor to you guys and to many other financials on geopolitical risk is being able to look beyond the headlines, being able to draw on my experience as an operations officer, street work in Moscow and Beijing, some of the nastiest places on the planet if you're a CIA operations officer. I mean, Beijing and Moscow could be wonderful places, but if you're a spy trying to do your job on the streets there and the local security service trying to prevent you from doing that, it can be a pretty hostile environment.
In 2022, as it became clear that Russia was going to invade Ukraine, implied volatility in both crude and gold ramped hard. Some context, 1 month implied vol in the GLD peaked at 30 in mid-March 22, doubling from its level a month prior. The same occurred in crude, where 1 month implied vol surged from 40 to nearly 80. Correlations can also have a tendency to run amok from geopolitical dust-ups. Gold is consistently negatively correlated to the dollar, averaging in the negative 70% zone. But during that uncertain period in March of 2022, this correlation flipped to positive 50 on a 1-month basis. The same phenomenon happened in the correlation between crude and the dollar, where the correlation, averaging around minus 40, spiked north of positive 50% for a short time as the war was initiated. War can wreak havoc on geopolitically sensitive assets and vol surfaces. When crude surges, there's a potential inflationary consequence. And that's where I'd like to go next. Among my 25 sayings on vol and risk, one is, quote, the next crisis to occur is the one that happened longest ago. And in 2019, I was suggesting, with no bet placed, mind you, that was going to be inflation. As Billy Joel sang to us, we're only human. We're supposed to make mistakes. And the human tendency to forget is a real one. With the last inflation shock nearly 40 years in the rear view, who could really have been spending a lot of time worrying about another one? Even negative policy rates for a lengthy period of time in parts of the developed world failed to get inflation back to target. But COVID, through the impact on supply chains and through the breathtaking combination of global, fiscal, and monetary response to it, delivered on inflation. Who could have imagined sitting at 1.5% in early 2021 that year-over-year CPI would surpass 9% the following year? Inflation is a lot of things. A silent, creeping default, a tax. It imposes uncertainty on businesses. It can be quite regressive with respect to its impact on consumers. And, as Maziar Minovi and his team tell us, inflation has political implications as well. He says,
what we found is striking. We found that in countries that have elections, that hold elections, during the inflation spike or in the 2 years after, the risk of a government turnover was about 80%. And you see that in the experience of the elections we've had so far in the last year or so, where government after government has fallen. I think the only country that has not changed hands is Orban's Hungary, which, we're all familiar with the methods he uses to maintain control. So 80% is a very high number. As an investor, your next question is, well, what's the normal turnover in elections? Because governments turn over all the time. That number is 40%. So first order political implication of the inflation spikes we've seen is that looking ahead at the countries that have elections in the next year or two, you're going to have to expect a lot of turnover.
Let's appreciate some of the interconnectivity of all of this. An overseas geopolitical conflict emerges. It impacts key prices like crude and natural gas. There are potential inflation implications which central banks need to incorporate into their reaction functions. Further, there are political implications that result from the inflation outcome. And, of course, market prices respond to both inflation uncertainty and the realization of an unexpected inflation. With that, part one of our 5-year anniversary podcast comes to a close. We've covered a fair amount of ground, devoting time to exploring the way in which asset prices are impacted by risks of various kinds. There's more on the way, and I do hope you tune in for part 2. Thanks for listening. You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback. As we aim to utilize these conversations to contribute to the investment community's understanding of risk, your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.